Manish Sonthalia, Senior Vice President and Head Equity Portfolio Management Services at Motilal Oswal, joins us on the show right now. Manish, hi, good afternoon. The last time we were chatting, and I remember we were in the midst of that mid-cap carnage, and you said this is going to stop soon. It's going to last at most, 1 week. And sure enough, it did. Ever since then, there has been a meaningful rebound coming in. But would you say we are out of the woods, or do you think this is just some rebound because they were so beaten down and we could very well get back to those down days?
No, so Aisha, there is nothing called just-in-time investing. So if people are finding comfort of mind buying large caps today just because they are moving up, or they can move up, let's say another 2, 3, 4 months, 5 months. I mean, there is where you cannot make serious money, but there will be comfort of mind. At the same time, if you are buying mid caps, maybe you will have to bear pain for some time, but there is where the deep value is. So I am clearly of the opinion, if let's say mid caps have to offer deep value at today's prices, if due to some reasons they have to fall, they will become even more valuable. That's the only point that I'm trying to drive at. But things are getting excessive on either side, both the mid caps and the large caps. That's my broad point.
You don't fear at any point that maybe large caps could go the same way, or do you sense that there is a better chance that the side market will revive and try and catch up with the large caps?
My sense is, there's going to be reversion to on both sides. There'll be some profit taking on the large caps, and there'll be some pullback in the fall in the mid cap and the small cap space. So there will be reversion on both sides. You're going to see some appreciation in prices across the board. The decent ones, of course, in the mid and the small caps, and obviously the large caps, and again the decent ones have seen some very good run up. They are likely to see some profit taking.
Okay, how are you viewing the PSU Bank recap as well as the consolidation story going forward, Manish? We just had the SBI chairman put it out as blatantly as possible, saying that we can't take any more bad bets or bad entities on board to, just further the government's consolidation program. How do you see the end game for PSBs in the light of the Cleanup Act?
So all hopes hinge now on the recovery process, the ones that have gone to the NCLT and the ones that are yet to go to the NCLT, the entire resolution process. My sense is 75–80% of the recognition part has been taken care of thanks to the February 12th circular of the Reserve Bank of India. A lot of the pain has been identified. In fact, the last quarter was a kitchen sinking quarter for all banks per se. They had to identify everything, which was even 1 day past due in terms of recognition of non-performing assets. But how do you solve the problem of getting back the money which is locked in these NPA accounts? I mean, that is the million-dollar question. And in the process, what's going to happen to your credit growth? I'm talking about the PSU banks, the state-owned banks, because there is a capital constraint, and that will actually hinder the credit growth. So, it's more about recoveries than actual new business per se for the state-owned banks, which is actually going to drive the stock prices on the higher side. But having said that, I think valuations are anemic at these prices, and it's unlikely that these prices are going to stay at these levels for, if you were to take, let's say, next 2–3 year point of view. But can you be a brave heart and pull the trigger on state-owned banks at these prices? I wouldn't do that. I mean, there could be contra bets on the state-owned banks, but I'll give it a pass. I'm not going to take a call just yet, unless and until I see some recoveries coming through, some credit growth on the top line, the NI, in this case of state-owned banks, I'll just give it a pass.
You're saying OMCs are a good buy. Why is that, Manish?
Just because of pure valuations and just two matrices out here. One is a call on crude prices, and the second is a call on the rupee per se. So my assumption is that, and this on the back of having read expert reports on direction of crude from where we are today. So I think the trajectory is more on the downside as opposed to upside. So if we were to build in, let's say $70 or $72 on the Brent, and if we were to build in, let's say around 69 to 70 from next 1 year's perspective, then I think valuations would give you adequate comfort. And we have done all our checks, and we believe that deregulation is obviously happening, but the entire thing now hinges on how much marketing margins, they'll be allowed to make marketing margins, but obviously how much of marketing margins are going to get allowed in the case of your total margins. One element is your gross refining margins and the other is your gross marketing margins, and then the net marketing margin. Obviously there is shrinkage in the net marketing margins as we speak, and obviously this being an election year, that's the most sensitive side of the fundamentals of oil marketing companies. But everything put together, valuations are very, very comfortable, both on let's say price to earnings front, and even on dividend payout, dividend yield, whichever way you may want to look at it. So there's deep value in OMCs is what I think.
Right. And Manish, would that view on oil also play out and hold true for aviation? Does aviation look attractive right now, or would you say that, because there is still no clarity really emerging on which way crude prices are moving, you would also want to pay heed to the passenger load traffic as well, which has seen a bit of a dip month on month, and the fact that pricing power isn't really in the hands of aviation companies. So would you be more tilted in forming an opinion within aviation with regards to these 2 pointers?
So, in the case of aviation stocks, obviously one imponderable is the direction of crude oil prices, and obviously, that is one element which only gets passed through over a period of time. In the case of aviation companies, there is no direct pass through immediately. So, for the immediate term, near term, if let's say crude prices spike up significantly, then you're not able to pass it on just immediately. You take that upfront hit on your profitability, and secondly, there is no pricing power, absolutely zero pricing power, because the bunched up capacity that has got built up by a few airlines, and these two on let's say not the metro routes, but let's say tier 2, tier 3, there is somewhat of a glut because in terms of passenger seats and the traffic. So playing both the equations, bunching up of short-term capacities getting created, coupled with cutthroat competition in the space, and let's say crude oil prices being very unpredictable. So if let's say crude oil prices have come off its highs, then obviously they are going to recoup some of the losses which they incurred in the previous quarter. You would know that they reported pretty bad numbers, the entire aviation pack per se. So some of those losses get mitigated, but is it very good times for the aviation companies? I wouldn't think so, unless and until the pricing power comes back in the hands of the airline companies. The sector is in a limbo for the time being.
In fact, hedging plays also come into play. So not necessary that if crude has come down from 80 to 75, that means they are benefiting out of it. And same applies when the crude oil price goes up. Manish, Siddharth joining in conversation now. Cement space, and we are getting two different views. We had this one foreign broking firm talking about that cement companies are now concentrating on taking market share and concentrating on the top line at a cost of margins. And there is other view which says that it's been like cement stocks are at 2 years low, and valuation wise they are quite cheap at this point of time. Which way you would be tilted, or as a investor, which opinion I should give more weightage to?
So again, it's a play long term versus short term. Obviously, I think for the near term, things are looking somewhat wobbly for the cement companies per se. And this at this given point in time, actually the southern region seems to be the major problem area. This entire price volume discipline seems to be breaking, and that will create a ripple effect across the cement space. If this happens, because you would know that if there is unutilized capacity in one region, then if there is good demand in other regions of the country, then there is an arbitrage opportunity, which means that cement tends to move from where there is underutilization to parts of the country where there is enough demand. So obviously the northern part of the country is where maximum capacity utilization stands, and there is around 50% capacity utilization, or 50 to 60% capacity utilization in the southern part of the region. So if there is a price volume discipline which seems to be breaking, then you will have many more players push through more volumes at lower prices. So I mean, that is where the maximum damage will happen on the profitability front. And valuations being what they are, I think if you get cement companies at less than $100 EV per ton, there is some margin of safety. But if you have valuations standing at $125, $150 EV per ton, and there is some deterioration in near-term fundamentals, we could see some correction. But given the fact that mid-cap cement companies have really corrected very sharply, I think there is far more comfort in the cement companies which are represented in the central region of the country, which is going to see the least amount of capacity addition over the next 1-2 years. And at the same time, valuations being less than $100 EV per ton, the long-term fundamentals being what they are, I don't think there's going to be significant damage from these prices. However, vulnerability again out here is more with the large caps, I would believe.
Manish, we let you go at that. It was very interesting chatting up with you and discussing your ideas in the markets currently.
Thank you.